Welcome to The Deep Dive, your shortcut to being well-informed on the stories that truly matter. Today, we're plunging into Land's End's second quarter 2025 earnings results. Now, it's a brand, many of us probably associate with sturdy basics, maybe even that catalog showing up.
Right, the classics.
Exactly. But what's really interesting and what we'll unpack today is how this legacy brand is trying, maybe even desperately trying, to reinvent itself in a super fast digital world. Can they actually pull it off?
That's the big question, isn't it? These earnings, they aren't just numbers on a page. They really give you a crucial snapshot of how basically any legacy retailer is battling shifting consumer habits, those stubborn tariffs, and just relentless pressure to innovate.
Okay, let's cut right to the chase with the headline numbers, because the market reacted pretty sharply to these. Land's End's second quarter, well, it delivered some decidedly mixed signals. The company reported a GAAP EPS of negative $0.12. But the adjusted EPS, which, for you listening, strips out some of those one-time charges to give a clearer view of core performance, was negative $0.06.
Which missed estimates.
Yeah, unfortunately, it missed consensus estimates by about 3 cents. And that's not just a slight miss. It kind of signals that even with these strategic moves, the underlying challenges are still hitting profitability.
And the top line, the revenue story, that was also softer than people expected, came in at $294.1 million. That's a 7.3% decrease from last year.
Okay.
And maybe more notably, it missed analyst expectations by a pretty significant chunk, $28.3 million.
Yeah.
So that revenue shortfall plus the EPS miss, that definitely fueled the cautious mood right after the release. Suggests the strategies aren't quite hitting the top line yet.
Right, not the pace the market wants anyway. But, okay, it wasn't all red ink, which makes this story a bit more complex, doesn't it? Gross margin actually showed some decent improvement, climbed 90 basis points year over year to 48.8%.
Yeah, that was a bright spot.
So what's the real insight there? Is that just luck, or is it maybe a sign that some of those deeper operational changes are starting to work?
Well, what's interesting is, despite the revenue dip, that margin improvement hints that management's rigorous cost control, their efficiency efforts, they might be starting to pay off behind the scenes. They chalked it up to better promotional productivity, basically, not discounting as heavily, making sales count more, and also a favorable licensing mix. So even with top-line struggles, they're getting smarter about the sales they do manage to make.
Okay, so maybe a bit of a silver lining in those margins. And what about operational cash flow, adjusted EBITDA?
Right, adjusted EBITDA earnings before interest, taxes, depreciation, amortization, a key measure of that operational cash flow, it came in at $14.1 million. That is down from $17.1 million last year.
Okay, down, but...
But on a more positive note, their inventory management. That remains a real strength for them. Inventory levels were down 3% year over year. And get this, it's the 9th consecutive quarter of decline.
Wow, 9th quarter.
Yeah. And that's crucial for you to understand because it shows tight control over working capital, less risk of big markdowns in this kind of environment.
Yeah.
It's a sign of discipline.
Okay, so disciplined on inventory. Let's move beyond those headlines then and really dig into the core financial health. What's actually underpinning their balance sheet? Are they solid or are there, hidden vulnerabilities?
Well, looking at the balance sheet, they reported $21.3 million in cash. Decent buffer. They've also got $87.6 million available under their ABL, that's their asset-based lending facility.
Right.
Now, that's against $35 million they've already borrowed on that ABL and a $240.5 million term loan. So what does that tell you? It suggests they have, adequate liquidity for now.
But there's a debt.
But also a meaningful debt load they really need to manage, especially if interest rates stay higher for longer. One other point. They bought back $1.7 million in shares during the quarter. Still have $8.8 million left on that authorization through March 2026. So signals some confidence in their own value, I suppose.
So, okay, a somewhat mixed financial picture then. Debt to watch, but some liquidity. Management, though, in their comments, they painted a much more optimistic view, emphasizing what they called encouraging momentum. What exactly did they mean, and what's the core strategy they're pushing here for you, the listener?
Yeah, the encouraging momentum line stood out. What's really central to their story now is management leaning hard into this asset-light, low-capital intensity operating model.
Asset-light, okay.
The CEO highlighted that this shift, this strategy, is helping product flow faster and it's generating, quote, higher quality sales. They're explicitly trying to evolve into a distributed commerce model.
Distributed commerce, meaning?
Meaning focusing on meeting customers exactly where they are, whether that's social media, maybe third-party marketplaces like Amazon or, their own websites. This strategy, they believe, is absolutely critical for growth, especially with these persistent tariffs and ongoing supply chain issues.
Right. Less money tied up in stores and warehouses, more agility.
Exactly. More flexible in how they reach you.
Okay, that distributed commerce idea sounds key. But how did the different sales channels actually do under this new strategy? Did it work everywhere, or were there some surprises?
Yeah, the performance really varied quite a bit by channel, which I guess shows what that distributed approach actually looks like on the ground.
Uh-huh.
The Outfitters business, that's their B2B side, was a definite standout. It grew 5.1% year over year.
Nice.
Driven mostly by new school uniform wins and also deepening relationships in sectors like travel and banking. They even managed to win back a major airline contract. That's a big deal in the B2B space.
Okay, so that B2B growth is genuinely strong.
Yeah.
But is that success kind of masking weakness elsewhere? Or do they see that as a sustainable model they can grow?
It's definitely a clear win, and management seems to think it is replicable. They're investing there. Then you have third-party marketplaces. They also saw really robust growth, up 14.3%.
14%, wow.
That's notable strength on platforms like Amazon and Macy's. They did something interesting. Launched a targeted Lands and Essentials line just on Amazon, kind of aimed at grabbing new customers who might then hopefully move over to their main site later.
Smart.
And here's where it gets kind of interesting for you listening. The CEO mentioned using AI. Specifically, using AI to customize the product display pages, the PDPs, for different platforms.
Ah, like tailoring the descriptions for Amazon versus Nordstrom?
Exactly. Optimizing the language, the presentation for each specific audience. It's a very modern sort of tailored approach to selling online.
Yeah, that shows some real digital savvy. Okay, what about licensing? That always seems like a capital light way to grow a brand's reach.
Absolutely. And licensing revenue surged. An impressive 19% year over year, or actually, based on some Q&A comments, maybe even 36%.
36, okay.
Yeah, reflecting increased brand visibility, expanded reach, all without Lands' End having to put up heavy capital themselves. This includes things like new footwear introductions in club stores, so they're expanding categories, reaching you in maybe unexpected places without taking on all the inventory risk.
Okay, so strong points in Outfitters, marketplaces, licensing. Where was the weakness then? What dragged down that overall top line?
The primary drag was their own U.S. e-commerce. That's on 11.2% decline.
Ouch. Why?
They mainly attributed it to a slower start to the swim season this year. But despite that, management did note strong momentum building through the summer, and they called out a particularly strong August. So they feel like that positions them better for Q3.
And they're investing there too, presumably.
Oh, yeah. Investing heavily in things like AI-driven recommendation engines, personalized campaigns for that channel, trying to make their own site more dynamic, more relevant for individual customers like you.
Okay. And Europe, I think you mentioned challenges there too.
Yes. Europe also faced headwinds. Sales there were down 15% year over year. Combination of, well, some supply chain issues still lingering, plus broader macroeconomic pressures over there.
Tough market.
It is. But they are seeing some early progress from adding new channels like Amazon, Next, Debenhams over there, and they're making efforts to kind of elevate their brand sites in the UK and Germany. They even mentioned plan designer collaborations to try and boost their presence. So tough, but they're not just sitting still.
Right. Okay, let's talk tariffs. They're just a constant headache for retailers now. I'm really curious, how is Lands' End specifically navigating this? Are they finding clever ways around it, or are you, the customer, feeling the pinch?
That's a critical question. Absolutely. Yeah. And yeah, the company confirmed their Q3 and four-year guidance explicitly includes the impact of tariffs at current levels. So they're baking it in.
Okay, they're acknowledging it. How are they dealing with it?
They've been implementing mitigation measures. Things like repositioning their sourcing network, shifting production where they can, maybe to Vietnam or Latin America away from China.
Yeah.
We're also working with their vendors to try and share the burden.
Sharing the pain.
Trying to, yeah. But while they aim to absorb as much as possible internally, management did admit that a relatively small portion of that tariff increase is being passed on to you, the customer, through price adjustments. Not ideal, but maybe unavoidable for them.
Okay, so that covers the recent past and the present reality. But what about the road ahead? How is management guiding us on what to expect for Q3 and the full year, especially with these strategic shifts?
Right, the guidance. For Q3 fiscal 25, they're projecting net revenue between $320 million and $350 million. Adjusted EPS they see ranging from $10.22 and adjusted EBITDA between $24 million and $28 million.
Okay. And they mentioned GMV too.
Yeah, they expect mid to high single-digit GMV growth. Gross merchandise volume, basically the total value of everything sold through all their channels. It's a good indicator of overall sales activity.
Got it. And for the full fiscal year, how did that picture change, better or worse?
Well, the updated full-year outlook for fiscal 25 expects net revenue between $1.33 billion and $1.4 billion. Adjusted EPS between $1.62 and 88 cents. So they raised the bottom end of that range a bit.
Interesting.
Adjusted EBITDA in the range of $98 million to $107 million. Again, tightening that range upwards slightly. Capital expenditures expected around $25 million.
And they mentioned a strong start to Q3.
They did. What's particularly telling, maybe, is management noted a very strong start to Q3. Labor Day weekend sales and margins, they said, were their best in a decade.
Best in a decade. Wow. Why?
They fueled it, they said, by their weatherproofed assortment strategy, focusing on versatile, season-agnostic clothing, easier inventory, more consistent sales, and also better promotional discipline around the holiday. So maybe indicates their strategy is finally starting to gain some real traction.
Okay, that strong start is definitely something to note, but considering that initial market reaction, the stock dipping significantly after hours, how should you, as an investor or observer, contextualize these results and the outlook? Seems like management sees one thing, the market reacts to another.
You've hit it exactly. The immediate market reaction reflects a kind of laser focus on that revenue miss and the EPS miss. Some analysts pointed out that the guidance, was improved, the range was higher, but maybe it didn't fully offset those Q2 shortfalls in the market's eyes.
Right.
That contributed to this sort of cautious neutral sentiment after the call. So despite the margin progress, despite the higher full-year ranges, that top-line softness and the ongoing tariff overhang just kept investors a bit skeptical. Classic case.
Yeah.
Tape focuses on the misses. Management emphasizes the momentum they feel they're building.
So what are the broader macro trends here? Is Land's End just dealing with its own issues, or are they riding a bigger wave in discretionary retail?
Oh, they're definitely not alone. Discretionary retail generally is grappling with these dual pressures, tariffs, plus pretty mixed consumer spending patterns. The broader market's been near record highs, partly on hopes of Fed rate cuts.
Which could help these stocks.
Could be supportive for discretionary multiples, exactly. But that tariff uncertainty, it remains a significant overhang for a lot of players in this sector. So Land's End's efforts to mitigate those tariffs are really crucial and definitely a watch item for you if you follow retail.
Okay. And looking ahead then, beyond just the next quarter's numbers, what are the key catalysts, the inflection points you should be watching closely? This is where it gets really interesting, I think.
Yeah, there are several things. Near term, definitely watch Q3, seasonal execution, outerwear, holiday sales, especially since management sounded so positive about the start. Developments on tariffs obviously remain critical.
But the big one.
But maybe the most significant potential catalyst is the strategic review process. Management stated it's ongoing. No further updates right now. But we know from reports earlier, firms like Authentic Brands, WHP Global, they'd reportedly shown interest over the summer.
Right, potential buyers.
Exactly.
Yeah.
So any news on a potential sale or merger, that could dramatically re-rate the stock. It's kind of the elephant in the room, overshadowing some of the quarterly noise, you could argue.
Okay, so that's the big potential near-term shakeup. But beyond that, how does this whole strategic shift, this asset-light distributed commerce thing position Land's End for the long game, say over a multi-year horizon?
Yeah, thinking longer term. If they can successfully scale up that outfitters business and the third-party marketplaces, all within this asset-light framework, that could fundamentally re-rate the company's whole story.
How so?
Well, if they can stabilize the top-line revenue and effectively contain that tariff exposure, the narrative could shift, right, from maybe a turnaround story to more of a steady cash-generative specialty retailer.
Yeah.
And their focus on distinct customer segments. They talked about the resolver versus the evolver.
Resolver versus the evolver.
Yeah, the resolver is someone buying out of practical need, like I need a school uniform. The evolver is maybe more fashion-forward, driven by lifestyle choices, tailoring their product, their marketing, using segmented catalogs, that AI personalization we talked about. It all points to a pretty sophisticated approach to building customer lifetime value, trying to speak directly to you whether you need a basic winter coat or something more stylish.
Okay, that makes sense. So we've dissected the numbers, the strategy, the market reaction. Now let's step into the realm of what if. And remember, this is not financial advice, just a thought experiment. But if you were to make a truly bold, yet maybe plausible trade based on everything we've uncovered here, what's your pitch?
Okay, my pitch. Considering the Q2 miss, yes, but also these clear strategic shifts and that ongoing strategic review. It's a contrarian long position on Land's End, ticker LE, with a specific catalyst-driven thesis.
Contrarian long?
Right. Well, Q2 results were, frankly, a disappointment on top and bottom line. Management's detailed talk about encouraging momentum into Q3, that best Labor Day weekend in a decade, the rollout of the asset-light distributed commerce model, especially that growth in outfitters and marketplaces, it strongly suggests operational improvements are taking hold. Real value is being created underneath the surface noise.
So the outrageous part.
The outrageous part for you is to ignore the short-term noise from this quarterly print. The company explicitly reiterated the strategic review is ongoing. They previously attracted bids, or at least serious interest, from major players like Authentic Brands and WHP Global.
Right. Those names keep coming up.
These talks, they're likely not just window dressing. They indicate real asset value, real acquirer interest. Look at the stock before this print, up over 55% in the prior 3 months. Some people were clearly betting on a deal. So my trade idea is buy LE now. Bet that the underlying operational improvements, combined with that active interest from potential acquirers who see the value in the brand's pivot and that disciplined inventory, that it ultimately leads to a take-private deal or some significant partnership at a substantial premium. Making today's post-earnings dip may be an attractive entry point. It's really a bet on the strategic value of the brand, not just this one quarterly report.
That is definitely a bold pitch and certainly something for you to chew on, especially if you have a longer time horizon. So let's recap this deep dive into Land's End Q2. We saw really a mixed bag. Some top line and EPS misses that spooked the market initially.
Right, but also strong gross margin expansion and a really disciplined inventory management, which is key.
And a clear strategic pivot towards that asset-light distributed commerce model with some channels showing real promise.
Yeah. Management highlighted encouraging momentum, especially in outfitters and marketplaces, and they provided that updated, slightly higher full-year guidance that, importantly, bakes in those tariff impacts. And as we discussed, that ongoing strategic review, it remains a huge potential catalyst, maybe overshadowing some quarterly bumps for longer-term folks.
Absolutely. And as always, please remember, everything we've discussed today is strictly for informational purposes. It is not financial advice. Always do your own due diligence. Consider your own situation.
Yeah, we definitely encourage you to look at the detailed financials yourself, maybe even listen to the full earnings call replay and consider that broader economic context. We just hope this deep dive has given you some valuable insights to work with.
So, as we wrap up this deep dive on Land's End, the question that kind of lingers for me is this. Can a heritage brand like this truly shed its old skin and become a nimble, digital-first powerhouse? Or are these strategic shifts, however clever, merely buying time until maybe a bigger wave of disruption inevitably hits? It's a question worth pondering, not just for Land's End, but really for the entire retail sector, and for your understanding of how old brands try to survive in new economies. Thank you for joining us on the Deep Dive.
Thanks for listening.
We appreciate you tuning in, and we'll catch you on the next Deep Dive.